3, 2, 1. Welcome to the show. We're back in the studio.
It is good to be back.
A little traveling on some two wheels.
Yeah.
We should do little videos.
Show from the road.
Yeah. Jerry did the show from the hotel room last week. Yep. Although we were together, we couldn't figure out a way to do. And we can do it when we're both in different places, but when we're both in the same place, it makes it really hard. Technology
is more complicated than it seems like it should be. Actually.
Yeah, it should. Yeah. Well, I mean, I guess we probably could have figured it out, but to be honest and transparent, we were too busy enjoying time in Florida on two wheels, getting a little wind time, on the motorcycles. It was nice. Yeah.
Pays to be retired.
Yeah, I mean, semi-retired. I always tell people, I'm like, still got to work, but I don't have to take leave.
Yes.
My boss signs my leave chit.
Yep, mine does too. It's fantastic.
We're out of here. Yeah. It's not leave when we're together. It's not vacation.
Yeah.
All right. Yeah. Well, hope you guys had a good week or so. And,
happy Mother's Day, because it's
talking
about that. So
today is Mother's Day.
Mother's Day.
Yeah.
Happy Mother's Day to all the moms out there. I don't know if my mom's going to be watching this. She doesn't. Her eyes might be rolling back in the back of her head. But
yeah. What you got for us this week, man?
All right. So it was a pretty interesting week. We had a couple different inflation data points. CPI came out on Wednesday. PPI came out on Thursday. And that was after last Friday's jobs numbers. So a lot of inflation-related stuff in the past week or so. So we're going to take a quick look at that and what the inflation data that came out, what effect it had on the market, if any, which really wasn't much. Everybody in the technical analysis world is really looking at small caps, and the term kind of gets thrown around quite a bit. So we're just going to look at what small caps actually are, and it's more or less our S fund. And then we're going to do a little follow up on Palantir. I think I did Palantir at the request of someone a few weeks ago.
Somebody asked about it.
Yeah, and so that was hopefully whoever asked about it kept an eye on the ball, because I didn't, and I wish I did. And we'll take a look at that. And then the weekly TSP fund charts. So CPI, Consumer Price Index, came out on Wednesday. PPI, Producer Price Index, came out on Thursday. Two of the biggest Fed metrics that they track to decide whether or not they want to raise, lower, or pause interest rates. So CPI shows U.S. consumer inflation in April was below 5%, which is the first time since early 2021. So the Fed's goal is to get inflation down to 2%. So this is the first time it's been below 5%, which is definitely a step in the right direction. There's a pretty big, not argument, but disagreement whether or not the Fed is going to actually be able to get down to that 2% target rate. And the closer it gets to 2%, the harder it is. So,
yeah, and that's fair though. I mean, we like to think that they're not lying to us. I don't think they are, but I think what they can't come out and say, we know we're never going to get to 2%. So the best we can hope for is like 3 or 3.5, or they want to get it down, right? And 2 is a great target, and but it's not going to be an easy target, right?
No, it's not easy to get there. And just so everybody understands, that's year over year inflation. So now it's CPI is 5%. That means that and that's why the picture is of a woman here in the grocery store. It's stuff that we use. It's consumer stuff, right? The next one is Producer Price Index. It's what companies use to produce products, but CPI is what affects us the most. And so at 5% right now, it means that stuff only costs 5% more than it did last year. If you extrapolate 5% every year, an increase, in anything that you buy, it's a lot of money. It's not like prices are going down. So when they say, inflation, disinflation and deflation are two hugely different things, right? Deflation means the price of something actually went down. Disinflation means it's not rising as fast as it was yesterday or last year. Or
right. Which is kind of what we're aiming for right now, right?
Yeah, we're aiming to slow the growth of how much more we have to pay for stuff.
Yeah, we're trying to slow inflation, not reverse it.
Right. I mean, arguably, deflation is a bad thing, right? When you think about the term deflation, 1929 and the deflationary depression and all that, so it's a bad thing. On the other hand, and it's bad for your housing prices and your stock prices. On the other hand, it's really good when the price of gas goes down, price of computers and cars and stuff goes down. We want that.
Yeah.
But we don't, but we want the stuff that we want to go up. We want the stuff that we want to go down. And you can't.
It's a delicate balance. And I will never envy the people, the policymakers that have to make these decisions. And what the interesting thing, I think, for me, as kind of I've always been sort of an information, I don't want to use the wrong words here. I mean, in the military, we called it psyops, right? Yeah. But it's kind of a bad term. What we mean by that is like, basically influencing people's behavior with information.
Sure.
And this is no kind of conspiracy theory thing, but I mean, that's what the media does, whether we want to accept it or not. And I don't know that that's necessarily a bad thing, but that's a different argument. But the point is like the information they give us, wherever it's coming from, influences our behavior, right? And so, the policymakers, 20, 30, 40 years ago, they had a few channels to talk to us with, right? Some TV, some radio, some newspapers. Now all that's out the window, right? We got 5,000 TV channels. We got podcasts. We got, all social media. And so now there's all these sources of information, and they can't really control that anymore. That's gone. And so they're just hoping that they can use these kind of archaic ways of influencing behavior, which is, lowering or raising interest rates to influence behavior. Not sure it quite works that way anymore. I don't know. Like, this is going to be a great, learning thing 20 years from now, where we go back and see, what really changed people's behavior during this time. Was it the Fed coming out? Like, it'll change institutional behaviors maybe, but is it changing the consumer behavior? I don't know. Because like we keep looking around and seeing like things are supposed to be one way and they're not. Right. And you're like, well, then how's this happening, right? And it's just because people are kind of writing their own story now.
Yeah, it's interesting because what you're talking about kind of affects the economy, but how those messages translate in the market versus the economy a lot of times are two in completely different directions.
And I think a lot of people don't realize those are two separate things. Yeah. Right? I think that most people think when you're talking about the economy, you're talking about the market. Yeah. And that's not the same, particularly when we're talking about the stock market. And there's lots of other assets, going on. But it's not the same thing. Basically. And it's funny, I had this conversation with my daughter. She's on the way back from college, brought her back yesterday. And she had micro and macroeconomics. Oh, cool. And her professor made them apply what they were learning in class to like current events. Mm-hmm. And she understood some of this stuff, and I was like, man, I wish somebody had taught me that one. It took me years to understand what's important versus what's not and all this sort of thing. And she knew it. She's like, oh yeah, it's not the same thing. And I was like, oh, the fact that you know that at 18 is you already got a leg up, right?
Yeah, so. Yeah, that's awesome. Okay, yeah. So 5% is a big deal because it's getting closer to the Fed's target. That was on Wednesday. Generated a little bit of volatility in the market intraday, but didn't move a whole lot. I don't remember what the actual closing price was that day, but didn't move a whole lot. Then on Thursday, PPI comes out, and it's only up 2.3%, right? So much closer to the Fed's target rate. And they look at, these are two metrics, but they look at a bunch of other stuff too. But anything that's getting down to that 2% level, they really like. So year over year, PPI is down 11 months in a row. Right, so it was 2.7 last month. It's 2.3 this month. It's the nearest any inflation metric has gotten to the Fed's optimal inflation gauge of 2% since what they're calling the Great Reopening. I didn't know that was a thing, but apparently post-COVID got underway. It also shows a dramatic reduction from the March 2022 high of 11.7%, which obviously that's a huge reduction because that 11.7% was inflation that was what we saw back in the early 80s. So core PPI year over year is now down 14 months straight to 3.2%. Core is a little bit different than the overall PPI, but so I didn't want to get into all these details up here. If you guys are interested, check it out at that Zacks.com report. But it's good news for inflation. On the one hand, it's good it did come down a little bit more than what analysts expected. Very little bit, very little bit of an increase in the decrease, which was why it didn't have much of an effect on the market, really. So, yeah, that's it. CPI and PPI. So, small cap stocks. So, small cap stocks. Our S fund is basically there's roughly 5,000 companies that are traded in the United States. The S&P 500 is the biggest 500 companies. The S fund incorporates the 4,500 smaller companies, is how they describe it on the TSP site. The index isn't really tracked very much, which is why it doesn't show volume. Like when you do DWCPF in stock charts or TradingView, it doesn't give you volume. So you have to use an ETF to kind of get volume. So a much more broadly used index is the Russell 2000, which we're going to show a chart about that. But small cap stock, public companies whose market value or market capitalization, which is just the number of shares outstanding times the share price. So if market cap is 250 million to 2 billion, so anywhere in there, it's called a small cap stock. The good things about small caps, generally at a company, so small caps between 300 million and 2 billion, investors seek to beat institutional investors by focusing on growth companies. So small caps tend to be growth companies, which are much more affected by interest rates, which is why the S fund was down so much more than the C fund last year. But small caps historically outperform large caps over time, but they're more volatile and risky when they're exposed to a lot. It's not just inflation and interest rate risk. There are other risks that small caps have that kind of big S&P 500 companies don't have. So, like I said, the Russell 2000 is a much better index for kind of tracking small caps. It focuses on smaller companies that basically make up the majority of the market. Right now, I'm sure if you guys listen to the financial media at all, there's basically 10 companies that have driven this rally since the October low. And we're going to kind of see that in a chart, because if the S fund is 4,500 out of the 5,000 and it's much lower than the C fund, then obviously the breadth of stocks that are participating in this rally is low, and that's why usually the S fund leads, because small caps are when investors are positive on the economy and things are forward expectations are good, they'll pile into the more volatile stocks that drive prices higher faster, rather than big cap S&P 500 funds. So if we wanted to trade the Russell, it's 2,000 companies, created back in 1984. It's used as a benchmark for performance of small cap mutual funds. Many investors see indexes breadth as giving it an edge over narrow indexes of small cap stocks. Investors can replicate the returns of the Russell by using ETFs that are based on the Russell. RUT is one, and IWM is another one. All right, so here's the RUT. Let's see the ticker symbol here. It's the Russell index. It's the RT. I can't remember if it's RTU or RUT, but it's the Russell 2000 index. We're going back to 2012, and it's weekly. Okay, so each tick here is a week of price movement. We are at a critical support level in the Russell. Okay, here's the top in 2018, the top right before COVID, and then we had all that stimulus money pouring in, so we broke through the double top after COVID and had a pretty good run in 2021, right? And then went sideways and peaked out in late 2021. And now we've come all the way back down to this prior high, where this double top should absolutely act as support for all this. And this is why we keep getting all these hits at that line. because it's a place where investors expect the market to move higher from here. It's been really choppy, right? You got this high, a little bit lower high here. It's not a great setup. If anything, it's a little bit of a triangle where the next leg down should be the same length as this one. So if we get below this red line, really, small caps are going down, and so is so is the C fund, because C fund's not going up with S fund going down, and in the big scheme of things. And again, this is the Russell. We'll get to the S fund in a minute, but on a big chart, support at these highs, and it was resistance back here. Now it should act as support. So it's something you got to watch really, really closely. So if you think that the market is going to go up from here, this is a great place to buy it, right? Because your risk, if you buy it here and it gets below the red line, you sell it, you've risked that much. But if it does find support and does start to break out, your potential upside is huge. So it just depends on how you want to kind of play the game. The other way to do it is to wait until, if it does go up, if it gets above this high, then it's much more likely to keep going. So we could have easily do something like this for a long time. Okay. So if we zoom in, this is what I was kind of drawing on the last chart. We zoom into the bottom here from COVID. We got this big run up, and this is that last prior high. And it's hitting the support level. But if, again, so what I did was the orange line, the length of the orange line is the same as this length, right? So we had basically an ABC correction in the first part of this drawdown. And that ABC correction was made up of the same length here, then we had the correction, and then the same length down to here, right down to the bottom. So if we follow that idea, the green line is the whole length, and this green line gets us to about 1350, and that's also the 61.8 retracement level, Fibonacci retracement level from that COVID low. So anywhere in here between 1380 and 1350, if we break down below the support level, we're likely to come down there to 1380 to 1350. Okay. All right. Palantir. We did Palantir a while ago. Not that long ago, but a little bit ago. Pretty interesting. So this is the whole life of Palantir so far. I mean, it was up here at $44 a share back in 2021 and got all the way down to somewhere in the sevens down here, and then had this monster rally. This is a daily chart. So this was a couple days ago. Monster move. It was like, well, it was 24% in one day. And then obviously RSI exploded in one day from the bottom all the way to the top, right? CCI, same thing. And if we had zoomed in here on MACD, it turned positive also. So if we zoom in and look at it, this is a 1 hour chart. Okay, so you would have had to have been watching this really, really closely. So each one of these ticks is 1 hour of price movement, and we had a gap down. So we have this trend line you could have drawn. We get a gap down through there. Price consolidates down. We draw this trend line, and then it breaks out right here, right? Broke above that trend line. At the same time, RSI got above 50, CCI got above 0, MACD had already turned positive. So you could have bought Palantir. This is an hour chart, but if you were watching it and you bought it in that hour, that was the first heads up that we were getting a big move in Palantir. And then it took 1, 2, 3, 4, 5, 6. So by the end of the day, that day of the breakout, it was starting to consolidate. People were starting to see it. And then on the open, that was the opening the next day. So You would have had to have been watching it really closely to get that 24% move to the upside, but you could have done it if you were looking at it on a 1-hour chart. And it's the same exact thing that we do on a daily chart. RSI gets above 50, CCI gets above 0, MACD turns positive. It breaks out, gaps up through a downtrend line, and it's off. So the methodology works regardless of the time frame. So hopefully whoever was asking us about Palantir before was watching it really closely. You'd have to be watching it awful closely, but still, you could do it. Okay. TSP fund charts. So this first one, I just wanted to, we've done this before, but I wanted to kind of point it out. This is a weekly chart going back to 1975. Okay. Actually, so this is into 1974 back here. This is a 200-week moving average in blue. Okay. So you got really one, I'm not going to count this because it's just kind of an overshoot. You got 1, 2, 3, and COVID is kind of an overshoot also. So it's really only the 2000 collapse, the 2008 collapse, and the time before that was back here in 1975. Those are 3 times, going back to 1975, that price got significantly below that 200-week moving average line. It doesn't happen very often. Every other time, a little bit of an overshoot there, but basically price always finds support whenever it comes down to that moving average line, except for those 3 times. Okay, it always finds support there. And it found support there in October. Now, we haven't had much of a move off the line since. So if you are bullish about the market in general, you could buy it anywhere in here and sell it below that 200-week moving average line. Or you can wait to see if we break out of this range, which we're going to get to in a minute, but wait to see the breakout. But the big takeaway here is if we get down here below a weekly close down here below that 20-week moving average line, it's a big deal because it almost always acts as support. So you don't want to risk this, is what I'm saying. People compare it to 2008. So what are they comparing it? Here was a top in 2007, and we're going into 2008. This little bit right here is similar to that, right? We've had a longer kind of rally than we did back here on this one, but everybody's looking for this breakdown right here. And if we get it, we go lower. So on a big scheme of things, historically, this support at this 200-week moving average line is really, really important. And if we drill in a little bit, this is the same chart. It's just drilled into, here's the top in 2022, right? But it's weekly. So this was the October low last year. It hit that 200-week moving average line exactly, right? Hit it here, tested it again there, a little bit of an intra-week overshoot. So 3 weeks in a row, and then we had that breakout on a weekly basis. And it's gone up ever since. Now, this looks a little bit, it doesn't look like a really huge move because it's weekly, and the way the chart looks, it looks relatively flat. But that's, I think S&P is up like 7% for the year right now. So, and that's for the year, that's from here. So it's probably a 14, 15% move from that bottom in October of last year to here. So 200-week moving average line is critical. So here's the other thing to point out. Everybody's looking at, obviously we have to get below this low. If we get below that low, it's a problem. We're probably going to retest the October low. That's the idea. What I'm looking at first, though, is this October low is, let's say, 34.50 or 35.40 rather. But the 200-week moving average line now is 37.80. So we could easily come down again to that 200-week moving average line and not get, time to check the market. All right. We could come down to that 200-week moving average line and bounce off of there and move higher and not retest that low because the 200-week moving average line has moved higher than it was in October. So the next 2 major levels that we're looking at is what happens at the 200-week moving average line. If we break through it, do we get below this low? If we get below this low, then we're obviously well below the 200-week, and then it does keep going down. So those are the two big levels going forward on the downside. As of today, as of right now, it's 37.80 and 35.40. So on a weekly basis, that's where we're at. And on the upside, this 4,200. I mean, it's we had an overshoot for 2 weeks right here, but otherwise, it's been a really important support and resistance level. So we got to get above 4,200 before it's really worth betting that the market's going to go higher. It's a huge resistance level right here. All right. S fund looks a little bit different than the Russell, but you can see it's quite a bit different than the C fund. So C fund, we got a move higher, a little consolidation, a higher high, consolidation, a higher low, which is good, and we're not quite at a new high relative to this one yet, but we might get there. But this chart of the C fund, it looks a whole lot better than this head and shoulders pattern chart of the S fund. You got a left shoulder, a head, and a right shoulder. We've been flat basically for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. A 9-week consolidation, and it's consolidating below that 20-week moving average line, right? So now we're back to the regular moving average lines that we do. Now the 20-week moving average line is acting as resistance to the upside. So price isn't able to get above that. That's not good. RSI is below 50. It's maintained below 50 and below that. The orange line is a moving average of the RSI. So it's not able to get above it. And MACD has already crossed negative, and it's been there for a while. And we have this head and shoulders pattern. So everything is really setting up for the S fund to move lower. It hasn't happened yet, but the setup is definitely there. So if it breaks this neckline, then we're looking, and it's already very close to that October low. That's the last possible place to get support. Could do a double bottom there and go higher again. But if it breaks that neckline, it's bad. And if it breaks this October low, it's off to the races to the downside. iFund, no doubt about it, looks way better than the C and the S fund. This has been a huge move off that October bottom. Once we got above the 50% retracement level, which was right here, we got a little bit of consolidation there at that 50% retracement level, came up, got above the 61.8, consolidated a little bit back down, and now we're trying to make a push to that 78.6 retracement level. I would think it would be very tough to get above 75-ish right here, above that 78% retracement level. RSI looks like it wants to roll over. You got 2 weeks of decreasing MACD, but it hasn't crossed negative yet. So iFund is definitely holding up better on a weekly basis than the C and the S funds. F fund, kind of interesting because it's a similar kind of pattern to the S fund, except it's 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks are above that 20-week moving average line, right? The moving average line is acting as support here for the F fund, where it's acting as resistance for the S fund. And same thing on RSI. It's above 50, just barely. It's floating above that 50 level, and it's finding support at its moving average line in orange. And MACD is positive, but relatively flat. Not a lot of momentum. So it's range bound, and until it gets definitely above 101, and on a weekly basis, really 102. I mean, if we get up here, then chances are we're moving higher from here. But there are a lot of arguments to be made that 1, 2, 3, 4, 5 is kind of my primary count. Or you can say 1, 2, 3, 4, 5. This was the bottom, and this is some kind of 1, 2, and it keeps going higher. But it should, if this is a real bottom, just whether it's the stock funds or the F fund, if this is a real bottom, this thing should be really blasting off. And it's a very weak movement off that low. So I don't know. It's just not something I'm willing to buy into yet, because you're at this point you're guessing. Until we get out of this range, you just don't know. And this range isn't big enough for us to really trade with 2 moves a month.
Yeah, it's very hard, and we don't play the guessing game.
No. So, okay.
Questions.
A lot of stuff in there this week. Again, I mean, I was talking about it on the newsletter a week or two ago. The summer, so May 1st started the worst 6 months of the year, historically for stocks. So, and there's a lot going on this summer. You can either go to the G fund and go on vacation. Nothing wrong with that. You're getting 4% or whatever it is in the G fund. I mean, that's pretty good. It's annual. So when, people throw around that number, 4%, that means if you left it in the G fund for a year, your account will go up 4%.
Yeah.
But it's guaranteed not to go down.
Right.
So, and there's so much volatility and risk. I mean, the macroeconomic risks out there are not getting any better.
Yeah, we're not necessarily recommending you stay in G fund the rest of the year, but
No.
if you are just absolutely off the grid, for whatever reasons, work, vacation, it's not a bad place to be. It's definitely not a bad place to be when the market's going down, which is how we play it, right?
Yeah. It's clearly not in an uptrend.
Yeah, exactly.
So if it's not an uptrend, I mean,
why be in?
Yeah, why mess with it?
So if you have questions, you can put them in the comment section wherever you find the video. If there is no comment section, you can shoot us an email at support@growmytsp.com. The support team will forward it on to us. If it's something about your personal circumstances, asking for stock tips or what have you,
can't really do that.
Can't really do that. I've actually had quite a few of those the last few weeks personally, and I'm like, I'm not in that business. Not giving stock tips. I'm not watching 5,000 companies and trying to figure out which one to tell you to go buy.
Yeah, I actually had a conversation with a guy last night that one of our subscribers, and he wanted to talk about the mutual fund window, and so maybe we'll do another show about that here in the next couple of weeks. I think we did one in January on the mutual fund window, and we can do another one because, I mean, I haven't been in it at all because nothing is working this year.
Yeah.
Nothing's really trending.
It has to be moving one way or the other, not kind of sideways.
Yeah.
Really to get the best use out of it. Yeah. All right, guys. Hope you enjoyed the show. If you did, please share it with your friends. If you didn't, share it with your friends anyway.
Absolutely.
All right. We'll talk to you guys later. Have a great week.
Out of here.